Hello everybody and welcome to the latest Service Department News webinar. Today we've got a very interesting session in store. We are going to be looking at how the market is going in various regions around the world. I don't think we've got the whole globe covered today, but we've got a good chunk of it. And we have got a wide range of regions and topics covered by our experts who we're going to meet shortly. My name's George Sell, I'm editor of Service Department News, and we are an online and multimedia platform for B2B news for the Service Department, apart hotel and extended stay sectors. Today's webinar is going to last an hour. If you've got any questions, then please do submit them using the Q&A or the chat function in Zoom. We'll either answer them at the time if it's about the subject that we're on, or we'll save 5 or 10 minutes at the end of the session. A recording of the webinar will be sent via email to everybody who's registered. So I just wanted to give the session a bit of context by showing you some screen grabs of news stories that we've run on Service Department News over the last few months, just to show some of the activity, of the players who we've got on the session today, and also the kind of things that are happening in the sector as a whole. So Yays, who we've got represented today, are expanding their European portfolio quite rapidly. The US extended sector, which is Mark's specialist subject, you could say, is seeing fantastic performance, and we've seen some really interesting brand launches in that space. Even this week, as recently as this week, the Hilton H3 brand. We've also seen Wyndham's Echo, and also a new brand from Hyatt. So there's loads going on there. And Urban Rest, who are also represented today. They have got two main areas of business now, and they probably couldn't be further away from each other. So the UK and Ireland and Australia. So we'll find out more about them in a bit. We've also seen other players entering new geographic markets. So Ratana, which is a UAE-based operator, has got quite a big slice of the market out there, is coming to London. Rooms, which is a UK operator, is entering new cities here. And then we've got an interesting section of operators who have kind of got one foot in the short-term rental, vacation rental space, and one foot in the service department space, the likes of Bob W. Others include Numa and so on. And they're also very active in this space and taking a bigger slice of the corporate travel market. So we'll talk a bit about them as well. So we've got a great panel here today. As I said, we've got a fair bit of the globe covered, which means we're in a lot of different time zones. So first up, we have represented the Americas, Mark Skinner from the Highland Group. Mark, good morning to you.
Good morning, George.
Mark, could you do a quick introduction, please?
Yes, Mark Skinner with the Highland Group. We're a hotel investment advisory firm, started in 1989, and in the late 1990s, when there was a surge in extended stay hotel supply, principally in the birth, if you like, of the economy and mid-price segments en masse. We started specializing in the segment, producing annual reports on the performance, and it has evolved ever since. And now we do quarterly reports and monthly bulletins on extended stay hotels.
Great stuff. Thanks, Mark. And representing mainland Europe, in Amsterdam, we've got Zachary Schwartz. Good afternoon, Zach.
Hey, good afternoon. Zach Schwartz, 20-year industry and real estate guy. I've been on board with Yays for the last 2 years, driving our business plan and our growth agenda forward. Yeah, excited about Yays as a brand and as a sector in general. I got a couple of themes and theses, I guess, for today. Theme number one, and the main one that I want to try to convey, is that service departments are really in the spotlight. Nowadays, we've got investors that totally get the sector, and we've got operators that can see all the benefits of being in it, and we've become mainstream. So Yays is a flexible and adaptable service department product, and our portfolio today includes premium locations in some of Europe's top performing markets like Amsterdam and Paris. We're one of the original pioneers in European service departments. We're mixing our 15-year track record with some exciting innovations, particularly as it relates to design. And at the same time, we're evolving from, and George alluded to this, a boutique regional player into more of a true pan-European platform. So happy to be part of the panel of peers today, and look forward to the conversation and debate. Thanks, George.
Excellent, thank you, Zach. And last but not least, easy for me to say, coming from Australia and representing APAC, we have got Jeff. Good evening to you, Jeff. Well, it's 11 p.m. with you, I understand.
Good evening. Yeah, lovely to be here. Thank you.
Jeff, tell us a bit about your role and a bit about Urban Rest.
Yeah, of course. So I head up the commercial team here at Urban Rest. Urban Rest is a relatively young but very fast scaling accommodation business. We operate a range of accommodation options across Australia and have recently expanded into Ireland, in Dublin. We're now operational in London and also in Singapore. And we really service the corporate market with our product, very focused on that corporate market and the way we operate there. And we're really trying to make a difference in our focus on design, wellness, and sustainability across our portfolio.
Excellent, thank you, Jeff. So as you can see, we've got a large chunk of the globe covered today, but not all of it. We have got an MEA, special MEA focused webinar coming up in Q3 or Q4, I'm not sure. I expect one of my colleagues might put the link up for that, but we're definitely doing that later in the year. Okay, let's crack on with the discussion. I'd like to ask you each in turn a fairly broad brush question to start with, and that's just how occupancy and rates have been trending in your particular region. Mark, would you like to kick off with that one?
In 2022, all extended stay hotels in the US increased ADR by 17%, one of the strongest annual increases on record, generally in line with the overall hotel industry rebounding from the pandemic-related losses. Occupancy, the economy segment and the mid-price segment more than restored occupancy back to 2019 last year. The economy segment has seen occupancy decline over the last sort of 12 months to about 74%, mainly because of rate growth. It's been very, very strong, the highest on record over the last 2 years. And it's still running in the economy segment about 5%, which is double the long-term trend over the last 25 years. So that's a very price-sensitive segment, and I think that and the falling apartment rents are probably what's causing the occupancy to decline. But the mid-price segment in Q1 2023 posted a 20-year high in occupancy, around about 72% for the first quarter. The upscale segment has not quite recovered occupancy back to the 2018-2019 period. Rate has more than recovered. So on an annual basis, it's going to get back to 2019 this year. Upscale was about 73% occupancy. ADR growth in Q1 this year ranged from 5 to 13% for extended stay hotels, higher at the higher price points. And that is slowing down, but it's still above the long-term trend.
Excellent, thank you, Mark. So a very positive picture from the Americas. Zach, how does that tally with what you're seeing in Europe?
Yeah, I would agree with a lot of what Mark was saying there. Could be mirrored in the European context. I guess if I go back to last year, 2022, in particular the summer period, we published a report about Ye's performance. We were 20% ahead in RevPAR on a same-store basis for summer 2022. So That was primarily driven by ADR, where we saw a bit of room for occupancy to still recover. Coming into this year, the biggest trend and change, I guess, is that Q1 was much stronger. We saw some hangover from the pandemic period with lockdowns in Q1 of 2022. Obviously, this year we had clear sailing, and yeah, things recovered very, very quickly. So ADR, I think, came back and exceeded prior peaks much quicker than any of us expected. And the road to kind of peak recovery on occupancy we see coming in the next 1 to 2 years.
Okay, excellent. Thank you, Zach. And Jeff, what these guys have said, how does that stack up against your APAC market?
Yeah, very, very similar trend. Although obviously we've got a slightly different seasonality in our market, given the fact that we are coming out of summer and heading into winter now. 2022 was an extremely strong year, particularly the latter half of that. We saw Australia had very strict lockdowns for an extended period of times. So as soon as those borders opened again, we saw a significant influx of travelers from across the world and also domestically, really driving up our occupancy and ADR, particularly in key cities like Sydney and Melbourne. Towards the end of the year, that growth was extremely strong, kind of continued early on in 2023. With a double-digit growth on an ongoing basis, month on month, within January, February, and March. We are now heading into winter, so we do see a slight seasonal drop-off of our usual market, particularly driven by a drop in the relocation market. People who tend to relocate to locations like Australia do that in our summer and the Northern Hemisphere's winter. So that is a normal seasonal decline, but it's been a fantastic Q1 for Australia and for the wider region.
Mm-hmm. Sticking with you for a minute, Jeff. So you mentioned that the relo part of the business slows down over the winter, but in broader terms, where do you see the business travel recovery? You mentioned earlier that you are essentially focused on the corporate travel market. So to what extent do you think it has bounced back to where it was pre-pandemic, and how are things different? You know, what does the market look like and how has it differed?
Yeah, for us, it certainly bounced back even stronger. And I think in general, it has bounced back for the broader market stronger than it was pre-pandemic, but in slightly different forms. We see less frequent but longer travel. So business travelers aren't doing those day trips or one-nighters between locations like Brisbane and Sydney, or Melbourne and Sydney. They are doing it a bit less frequently, but come up for 2-3 nights. So we see the length of stay slightly longer. But overall, that type of business is really strong for us, and general corporate demand has really returned. And also we see that a lot of the projects and consultancy business has returned in a very strong fashion. Lots of those longer 6, 8, 9 week projects that are returning from the big 4 consultancy businesses, but also from smaller, more boutique customers.
Yeah, excellent. Thanks, Jeff. Mark, that kind of 6 to 10 week business, the project business, the construction business, that's the kind of that's the core demographic for a lot of the extended stay hotel sector. But what's the kind of broader picture you're seeing in the business travel recovery in the US?
I mean, I think for the overall hotel industry, I don't know that business travel has fully restored back yet to 2019, but you would assume that it has, plus a bit, with extended stay hotels for the reasons you outlined. Construction as an industry is the single biggest generator of demand, particularly at lower price points. And there is a tremendous amount of construction going on essentially nationwide, but especially in certain areas.
And this trend for fewer but longer trips, is is that being echoed in the US, do you think? I mean, business travel is, I guess, is different in America because it doesn't necessarily involve that doesn't always involve air travel. You know, it's a different model from Europe. But do you think the fewer but longer trip model is taking off over there as well?
I think so. If you read the press, that's what is being talked about a lot. I can't actually see that within extended stay hotels. We don't track average length of stay, but it is tracked. Calibri Labs does do it. I haven't noticed any big changes in those numbers though. But you know, the broader trend is also, you know, adding on you know, a leisure day, a leisure night, 2 leisure nights on the back end of a business or convention trip. There's a lot of evidence that is occurring as well.
Yeah, thanks, Mark. And Zach, your corporate customers, are they also adhering to this traveling less but staying for longer trend?
Yeah, and I would add also not only fewer trips and longer stays, but more quality trips, right? Plays well for our service department business, where we can sell the product for both short and long stay. So we've definitely seen that trend firsthand in our property, in our portfolio, with a pre-pandemic average length of stay of roughly 3.5 nights, and now trending closer to 5. Mm-hmm. You've also got this other theme that's come up. I guess we're a pretty connected world these days, because it sounds like this is echoed in the US and in Asia as well. This idea of leisure, right, where we have people coming in midweek for corporate. They have a reason to be there for business, and then they're joined by their families, for example, at the weekend. So that concept we see playing out quite a bit. And then, you know, we've got as well this relocation business, which is particularly strong in the places where we operate. And so that's people that are relocating for jobs, and they would take their first month, for example, in one of our properties whilst they're looking for permanent accommodation. Mm-hmm. And so, yeah, the demand for that is strong in the places where we're operating.
Do you think this trend for longer stays, and if your average length of stay creeps up, will that have any impact on A, the services you provide guests, and B, perhaps the unit design? Would that mean you might start to look at bigger units if people are staying longer?
I think people are, you know, if product is designed well and the quality is there, they're willing to accept less square meters and less square feet than they may have historically. Mm-hmm. We've seen hotel rooms going to micro size designs. Whether that trend will continue into the service department space or not, we're certainly looking to pack more into the same amount of square meters in order to drive the real estate story and the ROI without compromising on quality and the look and feel. One of the things that we try to ensure is that we always have a fully equipped kitchen, and that's something that our customer expects from a service department product. So that's one thing that we don't compromise on. But we're getting more flexible and innovative on design in order to drive the thesis around you know, return on investment, so that we can find the right projects and partners to grow our brand. The other thing about length of stay is the impact that it has on operating margins. So we're already a pretty labor light model, but if you think about cost of room nights sold, and you think about cleaning costs, check-in costs, checkout costs, linen, all these things that are affected, the length of stay, the longer length of stay actually helps our margins. So that's another sort of positive trend for service departments. Mm.
And going to the other end of the spectrum, Zach, have you seen an increase in leisure demand, particularly since the pandemic? You know, the people were initially attracted to the self-contained sort of low touch nature of service departments. And I think a lot of people actually now will look for an apartment when they travel for leisure before a hotel. Has that had an impact on your business?
Yeah, I think you hit the nail on the head there. That theme of being able to control your own environment played very well during the pandemic, but people also realized just the general flexibility that controlling your environment as well as your surroundings works very much in a post-pandemic world. The other factor is sort of this desire for authentic experiences. So that's just an overarching trend, nothing to do with the pandemic, but less cookie cutter, more authenticity in everything that we do as humans, including our travel. And so it's been a main focus for us at Yays with our insiders, at their on-site staff, helping guests to unlock the neighborhood. And then what we do through the neighborhood guides and our local partners, we want guests to feel like the local living in the city where they're staying with us. So all of that plays very well on the leisure side, George.
Yeah, thanks, Zach. Jeff, when we were speaking before the call started, you said that booking a service department is kind of second nature for Australians. The market is very mature over there, and that service departments represent somewhere between 30 and 40% of the total hospitality inventory, which is, you know, a remarkable number compared with the rest of the world. So given that, why are you focusing exclusively on the corporate market, or are you starting to see a bit of leisure come into the mix, as it's such a normal way for Australians to travel?
Yeah, like you just said, the Australian service department market is very mature and represents a very large proportion of our overall accommodation stock. Most of that is branded service departments with, you know, some of the giants like Quest, Mantra, Oaks that have been operated in this market for a very long time. So the trend that Zach just described in people wanting more control of their environment, we've seen that as well, but probably in a slower way than most of the international markets, given the fact that a lot of people already book service departments as part of their leisure trips and corporate trips. For us, our desire to service the corporate market is really about building an ecosystem and supporting our corporate customers wherever they go. We've, like I said before, we've just opened in Dublin, in London, and in Singapore. That kind of spreading globally as an organization is a pure desire to service our corporate customers wherever they need to go globally, and building a brand and building a product range that is set out to service corporates. While we still have leisure guests in our product, in some of our products, not all of our products are sold on the open market, but some of our products are. We still service those guests, but really our product is built and is created for that corporate market. Our average length of stay delivering on that is a lot longer than the industry standard. At the moment would be around 30 nights plus on average across our portfolio, and working with our customers, it's really on supporting them in that field rather than broader leisure. Like I said, leisure is still part of our mix, but it's just a lot smaller than our corporate base. Yeah.
And do you lease your inventory, Jeff, or do you have management agreements? How does that work?
The far majority of our stock is leased, and is so our full buildings, large percentages of buildings. We do have a small proportion of our of management properties, but we often use that to get into new markets or in markets where it's harder to get access to inventory.
Mm-hmm. And what are you seeing as the biggest barriers to growing your portfolio as fast as you would like? Whether it's kind of development challenges for your landlords and owners, or convincing an owner to actually that you're the right company to sign a lease with. What are the things that are perhaps slowing down the rate of growth that you would like?
Yeah, well, to be really honest, we are growing extremely fast, and actually incoming demand on the supply side is extremely strong. We work very closely with a number of build-to-rent partners, both in Australia as well as in Europe, and we see that as a really clear opportunity for us to unlock a new part of inventory. that we didn't have access to before. Construction costs are rising, so these build-to-rent developers need to make sure that they have a really clear business case to sign that off. We often come in very early on in that piece, taking a bit of risk away for them and actually ensuring that these projects get off the ground. So in terms of things that are really hindering us, obviously construction costs are really hindering our landlords and our developers that we work with to get projects off the ground. But by working with us, we help them de-risking that. And like I said, their incoming demand is extremely strong for inventory at the moment, probably stronger than it's ever been for us before.
Yeah. And if I'm right, your London property, you've taken a floor or maybe more than one floor of a Greystar building, is that right? So is that a typical sort of landlord that you would work with?
Yeah. So both our properties in Dublin and in London. So Urban West Battersea and Urban West Dublin Port are in partnership with Greystar, a build-to-rent developer, and we will do more locations with Greystar across Europe. We also work here in Australia with other build-to-rent developers. Home, which is owned by GIC out of Singapore. We've got a partnership with in multiple locations here. That suits our model really well. So operating a significant part of the inventory in a larger building gives our customers access to a very high-end products, lots of fantastic facilities within the buildings, and allows us to scale very quickly. Yeah,
thanks, Jeff. Zach, you've signed a few new properties in the last year. Tell us about the kind of typical asset that you're looking for, and whether it's a standalone or whether it's part of a mixed-use development.
Yeah, no, we look for urban products. So we're looking for real estate partners and developers that want an operator with track record to come in and to run the property in a professional way. And so we sign long-term fixed and variable leases, and we do that with our partners in various markets, and that's really our model. So typically 20 plus year leases that we would be signing, and we're able to offer a great value proposition. The investment thesis, I think, for developers out there is very clear. They can get the ROI that they need for their project, notwithstanding some of the headwinds around construction cost inflation and the interest rate environment, which is obviously a little bit challenging from a growth standpoint. But versus traditional hotels, I think we offer a very compelling story. And if you think about real estate growth and development overall, and you think about sectors like office and retail, which may be more challenged going forward, the case for service apartments is even clearer. So we like the trend, we like the direction that it seems to be heading, and there seems to be quite a lot of interest in the sector in general and in the Yays product.
Mm-hmm. And is your biggest challenge actually finding enough suitable inventory to grow at the rate that you'd like?
In certain markets, like we'd love to have more inventory. Amsterdam is a home base for us. We have 9 properties here. We'll have 10 in the next couple of years. But we have more demand than we can accommodate. In terms of growing and evolving into a more pan-European platform, we've opened up with deal signings in Germany and Spain. So those are 2 markets that offer great scope for future development. And there are multiple urban markets and cities where we would look to expand. So the key for us is to, where we've outgrown certain markets, where the opportunities have presented themselves, and we can open up new markets and new relationships.
Yeah, thanks, Zach. Mark, the challenges in developing and acquiring new inventory in the US are slightly different. But what is interesting is as I mentioned earlier, we've seen 3 new brand launches in quick succession, and they seem to be very popular in flavour of the month. I mean, the speed with which Wyndham's Echo brand has taken off has been phenomenal. It's the fastest growing hotel brand in the US, full stop. These new brands seem to have been devised very much with owners and developers in mind. It's a low cost development model. It's a very clear template. Most the percentage of the square footage which is rentable is very high. Do you think this is a market that's only going to get more and more crowded?
Yes, it is. You'll probably see a couple of other brands as well, but if there's a worry about supply, I don't think it bears out on a national basis that there's going to be an oversupply situation, assuming that there's no correction in the overall hotel industry, which filters down to extended stay. If you look at it, CoStar's data just recently said there were 34,000 extended stay hotel rooms under construction in the US as of now, if you like. Well, all of those won't get built. But if you assume that they did, and they were all open within 1 year, that would increase the supply of extended stay nationally by about 5%. The average annual demand growth over the last 20 plus years has been 6. Okay. So, the supply risk on a national basis, overcrowding, if you like, I don't see that within the next couple of years. Now, on an MSA basis, on a particular market and indeed a sub-market, yes, all these new brands, in some respects, the developers are chasing similar spaces because the lower barriers to entry and the characteristics that make a good extended stay market, high employment growth, high population growth, relocation, construction. So there is a concentration in certain areas that would be somewhat concerning. But supply growth last year was the lowest it's been in a decade. And the last time that occurred, it took 4 to 5 years for supply increases to return above trend. And we're 2 years into that now. So there's going to be some crowding, but I don't see it on a national basis significantly over the next 2 or 3 years.
And it's worth pointing out, Mark, that a chunk of the occupancy at the economy end is actually people who live in these hotels. It's their primary residence because it's cheaper and easier than renting an apartment. Is that proportion of the guest demographic getting smaller as demand grows?
I think that there was some reduction, if you like, in residential guests as we got further away from the pandemic, because that, if you like, put a lot of people in economy, lower price, extended stay hotels, whether it became a temporary residence for whatever reason, or it was, travelers related to the pandemic. For example, medical personnel going into an area that experienced an outbreak. Well, once that's under control, they leave. So I think there has been that, but there is still, in the economy end, there's still a very solid base, if you like, of essentially residential guests that they don't change based on changes in the travel industry. I mean, they stayed throughout the pandemic because the government, for example, cut its travel budget and said no travel. Well, that doesn't affect somebody who's essentially living there, be that either permanent or on a semi-permanent basis.
Yeah. And sticking with you for a minute, Mark, I want to move on to regional hotspots, areas and markets where you expect to see a significant growth either in supply or performance? Where are the hotspots in the Americas right now?
Well, if I was to do it by state, I think the areas which are going to see the biggest supply would be Florida, Georgia, Texas, Colorado, and Arizona. But those are also states which are experiencing a tremendous amount of growth. There's a lot of construction going on there. There's a lot of relocation. So while there may be, an oversupply temporarily, I would think that demand will catch up on a statewide basis. Sub-market level, that's a little different.
Okay, thanks, Mark. Zach, you mentioned Germany and Spain as two markets that you are looking to get into. Could we drill down a bit and look at particular cities where you would like to plant a Yays flag if things went well over the next 5 to 10 years?
So if we kind of focus in on Germany, I think we've identified, seven major cities there that we're looking at. We've got deals and exclusivity in both Frankfurt and Berlin. Those are two markets that offer a solid base of corporate with interesting companies that are growing that would bring in the type of demand for relocation and corporate that we would look to accommodate in Yays product, but also offer some scope, particularly Berlin, some scope for leisure demand as well, to get sort of that 7-day market. So any sort of major urban area where there's a base of businesses there and trends in terms of local micro level growth, those are places where we would tend to focus. There's also certain parameters and cutoffs that we look at in terms of benchmarking occupancy and rate. So we would tend to study those trends to make sure that the potential there. But for us, it's always relative to the rent that we're paying. So even in secondary and tertiary markets, there could be opportunities for us to the extent that we find the right partners and the right locations and buildings in those markets. So we think that there's not only opportunity for new build and potentially taking over existing inventory, but there's also that scope I alluded to earlier in terms of office and retail in certain places and markets potentially becoming less viable. So we've spent a lot of time on that conversion story. We think there's a cycle in real estate coming for distress, potentially around office, where conversion to hospitality there'll be a very interesting and compelling investment thesis and business case. And then Yays will be prepared with a product that's designed for these conversions to step in and expand. Take Germany, for example, into many of those top 7 markets that I mentioned. We have a test case for this already, a vacant office building in a beach location in The Hague. We already operate in The Hague, and developer approached us with a vacant office building to convert it to a Yays. And this is a market that we like a lot, and it's a less obvious location, but because of the mix of corporate and particularly in the summer leisure demand that you get in Scheveningen, which is the location where we've signed, and the drive-to market that you have from Germany, the business case worked for us, and it'll take a 1980s office building and convert it into a high-end service department product.
Mm-hmm. Excellent, thank you, Zach. Jeff, tell us about the markets that you think are really going to take off in APAC, and also the other markets that you're looking at in Europe.
Yeah, absolutely. I mean, the key cities will remain kind of top of the list and highly sought after. Sydney, Melbourne, Auckland, and the like will remain very, very strong. But because those cities are ever growing and kind of maxing out its opportunity to grow, such as Sydney, for example, I think the secondary kind of satellite cities or that are attached to it, or kind of the secondary CBDs in those locations become much more important. So for Sydney, think about Parramatta, think about Newcastle, think about Wollongong, literally within that 1-2 hour drive away from Sydney. Melbourne, that's Geelong or other locations where we see great opportunity for us to grow. We do see great opportunity in the New Zealand market, given the corporate footprint that we have in Australia, and further growth in kind of other English-speaking markets. I mentioned Singapore. We've done a soft launch into the Singapore market. We expect to grow significantly there over the next year or two, and then also further expand on the European locations where we've just entered the market, particularly in Dublin and in London. That build-to-rent partnership that we've got with Greystar and with others, that's proving really successful for us, and so we'll certainly be building on that in further locations in those cities.
How did you find the experience of getting a foothold in Singapore? Because you're literally in the backyard of all the biggest players in the space. How did you get a foothold, and how do you envisage growing in that market?
Yeah, it's not an easy market to grow in. It is kind of the home base for one of the biggest players in the market. It's really about relationship building with the right partners and showcasing that proven model that we've got in different locations around the world, and through those relationships, taking on opportunities that arise, and that's why we've kind of soft launched into that market, and we see kind of opportunities for growing there in the future. We're certainly not competing, or we're very far away from competing for size in that market, but we'll slowly start growing.
Mm-hmm. I'm going to ask you all to put your objective hats on now, and I want to ask you about new players and new brand launches in your regions. If there's anything that you've seen that you found interesting in the sector, maybe a brand that's doing something a little bit different, and perhaps what you expect to see in the region in the next couple of years. Let's stick with you, Jeff, for a minute on that one. What's been happening in Australia for starters?
Well, I think what we've seen some of the co-living brands coming into the market, and while it's a very small proportion of the market, I'm really interested to see how that will play out. I think we see also a bit of the merging of the different markets. So, co-living goes a bit into student accommodation, a bit into corporate accommodation, a bit into service departments. Obviously a lot of the short-term rental plays, kind of becoming more fully fledged service departments. So I think that will be really interesting. I think it'd be interesting to see how those co-living brands, actually branded offerings play out. Like one of the particular ones, the Ascot's Life, opened here in Melbourne, I think only late last year. So it'd be interesting to see how that will play out in the wider market.
Yeah. Okay. Thanks, Jeff. Zach, I think Life has got big plans for Europe as well. But aside from them, are there any other brands that you see in the space, new brands that you find interesting, and how do you think this convergence that Jeff alluded to is going to play out?
I guess I'd go a little bit more big picture, trend wise and theme wise, as to what will happen in Europe. And I believe that we're going to embark on a journey of more brand segmentation within service departments, the way that the hotel space has segmented its customer. It used to be just Marriott. Now Marriott has 30 brands. And I think that what we're going to see in service departments is brands, as demand grows, segmenting their customer and differentiating their concept based on a particular location or target demographic. We've done that a little bit already, in the sense that we already have two brands. We've got Yays, which is our full apart hotel concept with on-site service and more akin to a hotel operation and a hospitality touch point experience. And then we've got our full digital solution, where you get the key on the phone and you go direct to your apartment. So the options historically in our space have been sort of Airbnb, and you've got professionalized service departments. I think we're going to see it go one level further, and I think we're going to start to see more differentiation in terms of brands within the same group or family group within service departments.
So you could potentially be looking at launching new brands under the Yays umbrella to offer different types.
I think that will be the direction that things head. Yeah.
And similar to, I guess, what Eden are doing with Lock and
and you've seen Stay City do it with their Wild brand. I mean, it's starting to happen already. I just think as demand grows and people become more familiar with what the offering is, they're going to look for more specific catered products in certain markets or locations, and that will offer scope for multi-branded or dual branded properties.
Yeah, thanks, Zach.
Sure.
Mark, we've touched on some of the new entrants in the extended stay sector. Do you think they're more around the corner? And if so, who do you think are the likely candidates to do it? And also, Mark, do you think this this model that Jeff mentioned with the multifamily housing leasing 2 or 3 floors to a service department operator, is that something that's prevalent in the States? And if not, could it be?
Similar things happening here. I mean, if you look at, say, a brand called Water Walk, which you may be familiar with, they've been around for a while. It's sort of a hybrid where hybrid multifamily apartment with unfurnished units and typical lease terms, if you like. And then based on market demand, they keep some of their units as fully furnished and essentially run them as an extended stay hotel. So you've seen that, hybrid. Another growth area are on commercially zoned land. You will see multifamily apartment developers in some cases doing a certain number, or in cases a whole building of furnished units that they can rent out for less than 30 nights. If it's on residential zoned land, which most are, you can't really rent it out for less than 30 nights. Mm-hmm. So we're seeing growth there, some creativity. I read some group has gone out and leased a lot of apartments, and then they were subleasing them. That in itself is not new, subleasing on a 30-night basis. What he found is that he had vacancy. So he created an entity which is almost like a subscription-based club, where you have the right to take an apartment in a given location for a period of time, so long as you agree to vacate the apartment within 72 hours notice. Because if somebody else who belongs to that entity says, I want it for 30 nights or 2 months, then it's more profitable to rent it to them. But this was like a filler, yield management, just the way a hotel sells unsold rooms on peak nights. That I thought when I read that, I don't know exactly who they are, but that was very creative.
Yeah. Thanks, Mark. Talking of various ways of selling inventory, we're going to start getting around to some questions from the audience now. And the first one here is from Richard Mayuski. Thanks, Richard. He asks, what percentage of business still comes through the OTAs as opposed to direct or specialist agencies? Jeff, do you want to kick off with that one?
Yeah, for us, it's OTA business represents roughly, it's just under 20% of our total business mix. It's obviously location dependent, and like I said before, we've got quite a number of our products that we don't sell on OTA channels at all. A lot of our relationships that we have with the bigger build-to-rent partners are corporate exclusive, and therefore we only sell via our own corporate channels and not via those channels. So that probably skews it a bit, but it's maximum 20%.
And is that a historically consistent level, or is that something that you're looking to reduce? How would that be trending?
It's been pretty static for the last year or so. Urban Rest has been a fast scaling business, and obviously at the beginning, when we still had to build that corporate base, that percentage was a lot higher. But it's been pretty steady for the last year. It's a bit of seasonality built in, obviously. During a lower season months, that goes up a bit, but pretty steady overall.
Mm-hmm. Zach, what's your distribution mix looking like, and how is it evolving?
So we obviously have put a big focus on direct, non-commissionable business. Today we stand 42%, so that's coming through to us either through yays.com or directly through our own in-house sales team, and we'll continue to make that a focus. But the rest comes through the OTAs.
Yeah. Okay. And Mark, would you know what the channel mix is for the US extended stay sector?
I wouldn't know in percentage terms for the sector as a whole, but I can tell you that use of OTAs will be far lower at lower price points than further up the chain in terms of rate. I know one particular economy brand that gets 90% of its revenues from guests staying 7 or more nights. And typically, 7 or more nights, i.e. extended stay, especially the longer term guests, don't come through OTAs. So, but I have seen others that, will make use of OTAs, more use of it, and certainly market by market. If you had an extended stay hotel, even at lower price points in South Florida, for instance, where you've got strong seasonal variations and much higher rates in peak season than out of season, you might want to yield manage through opening up to third-party booking channels a little bit more than you would normally if you were in, say, Atlanta or Dallas or something like that. You have that option to do it.
Yeah. Thanks, Mark. One trend that we're seeing across markets is there's a real dearth of purpose-built student accommodation, and the overseas student market here in the UK is becoming a significant guest demographic group for service departments. Is that happening in Europe too, Zach? I know Europe is also experiencing a PBSA shortage. Do students make up any of your customer base?
They do, to a larger extent. It was during the pandemic period when we didn't have as much of the transient higher rated business in the markets where we were operating. We did choose to take in some student type demand. You can stay with us for a night or up to a year, and anything in between. So we have the scope, and that's one of the reasons we like the business model so much, is we have the scope to pivot when demand trends change, either be from a cyclical trend change or a seasonal trend change. We can bring in different types of demand, and that does include student where warranted.
Mm-hmm. And how about with you, Jeff? Do you cater to student business?
Not as much. The majority of the cities that we operate in, cities like Melbourne, have a very well established student accommodation market, and the city is kind of set up to cater to students. So that's not really a market we see actively in our properties, particularly when corporate markets are strong. Okay.
We're going to round it up in a minute because we're getting on towards 3 o'clock. But I just want to ask the three of you in turn what you think will be the most significant changes to the sector and to your business in the next 5 years. Only has to be, a quick answer because it's a big question, but just the ones that immediately come to you. So Jeff, let's start with you.
I think, and something I go on about quite a lot within our business. I think our distribution and yielding opportunity will really mature and will really change within the coming years. We've obviously been held back by products like the GDS and others. I think direct connectivity to direct corporates, other ways of connectivity to direct corporates to distribute our inventory, to distribute rates and different rate plans is really going to open up great opportunity for us.
Excellent. Thank you, Jeff. Zach, how about you?
I guess I'd circle back on two themes that I mentioned already today. One would be the proliferation of brands and the segmentation of service department brands going forward as a trend. And the other would be capital. We didn't get a chance to talk about it, but the M&A space and consolidation of what's a fragmented marketplace in Europe is coming. That's one thing. And then generally just becoming more of a mainstream investment product. You'll see more institutional capital. We already have private equity, venture capital, family office in the space. And I think long-term institutional capital, like the CBRE global investors of this world that bought our property in Antwerp last year, I will see the value proposition, the pandemic resilience, the residential downside investment thesis, and I think that they'll choose service departments over traditional hotel, and I do believe that will be a trend that we see a lot of over the next 5 years.
Mm-hmm. And with this arrival of significant volumes of institutional capital, do you think we'll see an increase in the trend for having the real estate and the operating platform under the same ownership and the synergies that brings?
I think people will look at what Eden did and Brookfield backed platform of Eden, growing an owner-operator, pan-European, and look to replicate that. But so long as you've got new brands, this startup culture, brand origination culture, and capital light approach, you will see operators that continue to grow opcos in the way that we're doing. And I think propco and opco will stay separate in a lot of cases, but there will be more of the Eden type models, even if it doesn't dominate the space.
Mm-hmm. So the M&A activity that you see coming will be opcos changing hands then? You think they're going to be quite attractive investment opportunities?
I think the business model works on economies of scale. And so wherever that's a driving factor, I think you'll see companies coming together. And when you put economies of scale and an interest from capital together, that's always a driver for M&A. So I do believe that will come in many forms, both on opco and propco side. And in some cases, there may be an evolution of one to the other, depending on the type of capital that's coming in.
Yeah, thanks. So, finally, Mark, what big changes do you foresee in the sector ahead?
Well, I mean, brand proliferation, obviously, with the announcements that have been made. I think, there's some other players as well, which are not big names, which are developing extended stay hotels. If history repeats itself, they will get absorbed by bigger brands, I would think, at least some of them. And I echo the other panelists' statements. I think you'll see more investment from institutional capital. I mean, it's already happening, and I think that will increase because the segment really came to the forefront during 2020 and 2021. The very, very strong performance relative to the overall hotel industry.
Yeah, excellent. Thank you, Mark. Thank you all for your insights today. That was a really good, interesting session. I'm just going to run through a few slides, and then we're going to leave the session open for a couple of minutes because there's quite a lot of info been posted in the chat, so you can take some notes from that for a couple of minutes after we've finished. Touching on one of the themes that we've covered today, our next Service Department News webinar will be on June the 15th, and we will be focusing on investment and mergers and acquisitions. There's a link to register for that in the chat. This is a slide about our flagship event, the Urban Living Festival, which is taking place in London on July the 5th and 6th. And you can see a link to find out more about that and to get some tickets also in the chat. If you're interested in working with us here at IHM on any of our live events or our digital platforms, please get in touch with one of my colleagues, Katie or Steph, and you can see their contact details on the screen. And thanks very much for watching. Thanks to Zach, to Jeff, and to Mark for their insights. Thanks to everybody who sent through questions. If you're on any of the social channels, you can see on the slide there, give us a follow and enjoy the rest of your day. Thanks very much, everybody. See you on the next one. Bye-bye.